Hedge fund manager Bill Ackman not mincing words when it comes to the Fed, saying that the central bank will not be able to bring price stability down to its target. He also says stock prices could bear the brunt of that rate pressure. For more, let's bring in Yahoo Finance's Alexandra Semenova. Alexandra.
Well, guys, Bill Ackman has been urging the Federal Reserve to get serious about inflation since late last year. He started calling on the Fed to start tapering as early as October 2021, but now he has doubts about whether officials will be able to bring prices down meaningfully and down to their target. Ackman told Pershing Square investors in a quarterly call yesterday that he does not think that the Fed will be able to get inflation down to a consistent 2% level, which is its price stability objective in the long run. He said that inflation will remain structurally high due to a cohort of macroeconomic factors, including the transition to alternative energy, deglobalization with a broader shift to domestic sourcing and production, which will be more expensive for companies, and also rising wages across the globe. So inflation is here to stay in his view. And Ackman also warned that this will also ultimately continue to place pressure on equity markets. This is a view that has been expressed among other Wall Street strategists. BlackRock's Investment Institute earlier this year also made this point, saying that the Fed can't fix some of the secular macroeconomic changes that we have been seeing, like supply chain issues, rising wages, and some other concerns.
Now, Pershing Square has been underperforming. So what did Bill Ackman have to say about that, if anything? Yeah,
so Pershing is down year to date, though loss is not as big as the S&P 500's losses. But Ackman's bets on rising interest rates have actually paid off in a big way. He made roughly $2 billion this year and $5 billion since 2020, betting that rising inflation would push the Fed to raise interest rates through a series of hedges, including interest rate swaptions and an extended maturity. Now, on the equity side, Pershing is certainly feeling the pain of this broader market rout that we've been seeing, which he did note was a function of the broader market issues. Though on the interest rate focused hedges, they were enough to minimize some of those losses. Overall, the fund is down about 9% year to date. The equity position's down 22%, but he earned 13% on those interest rate bets. He did note that Pershing did incur a permanent 4% loss on its Netflix sale. And according to its recent 13F filing, his top holdings now are Lowe's, Chipotle, and restaurant brands. Of the 8 total concentrated holdings, only 2% are up this year.
Interesting. Gotta love talk about swaptions. What's interesting, too, is that going back to the interest rate call for a minute, he's certainly not the only one who's saying this, right? Another person you cover frequently, Cathie Wood, has said the Fed should not be, continuing to be aggressive with interest rates. So there is that contingent within the investment community.
Absolutely. It seems like there is a growing call among all investors saying that the Fed is really at risk of over-tightening policy, and that continues to be a concern, and that it can't resolve some of the other issues, as I mentioned, across the globe, like supply chain issues. Interest rates won't fix that.
Our Cathie Wood whisperer, Alexandra Semenova. Thanks so much.